In today's episode, we're going to talk about how we were able to plan to save over $2.8 million for one of our clients through tax planning strategies. So when implemented correctly, these strategies can save a lot of money, is ultimately our encouragement to you to make sure you're taking action and doing these types of strategies. And so for this client here, we're going to do Roth conversions is a specific strategy that we're looking at here, and the impact of how much I can impact so many other items to lead to these tax savings over time. And so for this client here, they were 62 years old, as you can see there on the screen. They had $2.1 million that we're looking to convert. So they had much more than that, but $2.1 million was the amount that we were looking to plan for during our projected tax plan that we do. And when we put together tax plans for our clients, we don't just look at 1 year, we look at 5 years, 10 years, 15, 20 years down the line to make the decisions today that make sense moving forward. And ultimately, our goal is not to pay more taxes on this Roth conversion than what we could expect to pay in the future. We want to pay the least amount of taxes possible, but we want to make sure we don't do too much to bump us up tax brackets we may never see again. But we also don't want to do too little to where we're leaving money on the table. And so that's why we're able to use our software and calculators to decide how much should we look to do. So after we ran all those reports and figured out what the optimal amount was, we came to this calculator here to show him, hey, through these strategies, here's what we could look to do in savings over time. And so I'm going to walk you through what this case looked like for them and how we're able to do that. And so we're just assuming a 6% growth rate here, as you can see on the screen. And we're also expecting that tax rate to be about 24%. So part of his strategy was, let's go convert up to the 24%. So some of that was in the 22%, some of it will be in the 24%, but overall we're looking to convert up to the 24%. This is also a strategy that we're looking to do over multiple years. And so again, these are just rough estimates, rough numbers, but just to give us an idea of how much savings there are through these types of strategies. And so that's the case there. So what we're going to first talk about here is, what if we do this conversion? What happens? And so let's say we take 2.1 million. Again, we're not doing this all in 1 year, but let's say we do this over time. 2.1 million at 24%, rough estimate, is about $519,600, which you can see there is a tax paid on this conversion. That's a lot of money. That is a quarter of that money. And we have to understand, though, is that the taxes on the growth is going to be tax-free. So you're not going to have to pay any taxes anymore. It's going to be ongoing tax-free. Now, you're going to see Medicare premium increases of $44,000. Again, this is another rough estimate, but we're expecting what their Medicare premiums would increase at during the time it took to do these conversions. So we like to think of Roth conversions as 1 or 2 or 3 time Medicare premium increases. Now, that's not always a good thing, but for certain people it can make sense, because if their RMDs are always going to push their Medicare premiums higher, maybe we want to convert now so our Medicare premiums in the future can be at the lowest tier. And that was a strategy that we used for this client here. Is how that worked out. And so, yes, we are expecting to pay $44,000 more for Medicare than what we didn't have to pay that if we didn't do conversions. Now, we would expect him to pay him when he reaches 73 in the future because of those RMDs. But for now, we're basically saying we're going to pay more to pay less in the future, and that's why we did that. And then also taxes paid on the beneficiaries for this 2.1 million. If it's all in a Roth, there's no taxes that beneficiary has to pay. And so the total taxes paid, the total cost of this, if you factor taxes and also Medicare premiums from a federal level, is going to be about $563,000. And I'm not going to show you the state tax side of things, because we get people all over the country about state taxes, and so that's going to be more particular to your state. But here in Ohio, there is some state tax there that we'd have to be associated with. If you're in a state like Tennessee, there may not be as money, or may not be any state tax, but just understand where you live, there could be multiple taxes on top of this that you need to be aware of. So total taxes paid at $563,000. Now, let's see what would happen if we did nothing, because you're probably thinking, $563,000, Joe, you're crazy. I don't want to give up that much money to the government. Well, let's just look and see what it would look like if we did not do anything, and if we just went status quo and followed what we call the IRS's plan. Now, under the IRS's plan, you can see the taxes paid on the RMDs are going to be $1.6 million over time. And the reason why is because this investment is growing at 6% per year, as we illustrated here. And so if this investment keeps growing and growing and growing, the amount you're required to take out at 73 increases. And so because of those two things, and also because of RMDs, the amount you have to take out goes up over time based on your age. It starts off about 73, about 4%, but then grows up by the time you're 90, it's about 8%. And so you can see that you're going to have to take out more and more, and you're going to have to pay taxes on that. And so we're just assuming a tax rate of 24%. We're just assuming tax rates stay the same in this illustration. As we all know, tax rates will probably go up, and we already know they're going to go up in 2026, but we're just trying to keep this as simple as possible just to give you a feel of how much savings this could lead to. But if tax rates are much higher, this illustration is going to be, this is a very conservative illustration. If we show tax rates higher, it's going to show you even more savings, but we want to make this conservative just so you can have an idea. And so that's how that works there on the RMDs, whereas if you compare it to the Roth conversion side of thing, you're paying all your taxes up front. You're not having to pay tax on any of that growth of that investment moving forward because it's tax-free. So that helps you illustrate the differences between that. And then the next line item here is taxes paid on reinvestment of capital gains. Now, we see a lot of clients where, they have 2.1 million that we're looking to plan for. They have 5 million total, 4 million total, whatever it may be. And for them, if they take out their RMD, they're typically not going to need that income. I mean, think about it. If you just have $2 million, your RMD is about $80,000 on top of your Social Security, on top of maybe a pension. You may not need all that money. And so what we see is people take that money out and they just reinvest it. And what do they have to reinvest it in? Well, it has to go into a capital gain type investment where they're paying taxes on the growth ongoing. Or it's going into their bank account where they're paying taxable interest, which could be worse than capital gains. And so because of those items, you're having to pay tax on any growth ongoing. So if you take out $100,000, yeah, you paid your taxes, but now as that money grows and grows and grows, you have to pay tax on that growth. You've already paid taxes on the basis of it, but on the growth you've got to pay taxes on. And that's where if we calculate, if you just take your full RMD at 73 and ongoing in this illustration, assuming they live till 90 is what we're using here, then you'd have to pay $357,000 in capital gains tax over time is what we could expect there. And so again, another unneeded tax, whereas if we did the Roth conversion, all that growth is tax-free. It's reinvested into a Roth, not into a non-qualified account where you have to pay tax on the growth. Roth is tax-free ongoing. So that's another perk of doing this type of strategy, especially when you have more in these tax-deferred investments. And then the next item here is Social Security taxes. So I've done many videos on Social Security taxes, and the way I explain is that not everyone has to pay taxes on Social Security. If your income is between here and here, which we consider lower income, there's no tax on Social Security. But as soon as your income starts growing and growing and growing, the amount of it is going to become more taxable. And there's something called a Social Security tax torpedo, where you could force yourself into a 40 to 50% tax rate because you're now forcing Social Security to become 85% taxable as income, and that will count as your income, and now it's going to force you up brackets is the idea. And so for this example, if they have this RMD every year ongoing when they're taking Social Security, we can expect them to have to pay $147,000 more in Social Security tax than if they just had a plan in place to keep themselves below that torpedo we just talked about. So again, understanding how all this stuff plays together, not only Medicare premiums, not only Social Security, not only capital gains, not only RMDs, how does everything play together to make the most tax smart decision for you to pay the least? And again, we're showing you kind of the high level understanding of this. There's many other softwares and calculations that we do and reports for our clients to determine all of these to see if it makes sense. This is just an overview of looking at some of the main pain points that many people bring up to us. And then the next item here is taxes paid by beneficiaries. As you can see there, it's $1.1 million. So you pass away, this money has to go to that next generation, and they have to pay taxes at their rates, at unknown rates in the future. And so if you're worried that tax rates are going to go up and you're worried that your kids are going to be making probably the peak earning years of their career, when you pass away, then this may be something that's important to you to make sure you get fixed and resolved. And so we can easily avoid that by moving it to the Roth now. Again, all that growth is tax-free. Now it goes to the kids tax-free as well. Now when the kids get the money, they have to take it out over 10 years. Same thing, deal with the Roth. The only difference is the Roth is there's no taxes on it. So that would be the strategic way of planning for that case there. So if that's one of your goals, also if your goal is to leave money to a spouse, remember the widow's penalty. And the widow's penalty says that the spouse is going to go from married, filing, and jointly tax rates to single. So we need to plan for that in advance. And so as you can see, their total taxes paid are $3.3 million if we do nothing. Compare that over to that $563,000 number and tell me how you feel. Are you okay paying that $563,000 knowing that this is what it could be in the future? And so these are the type of decisions that we have to make. And if you see there on the screen, $2.8 million is the tax savings over our lifetime. Now, this isn't perfect. It could be more, it could be less. But to give you an idea, we've got to act now. I mean, what would you do with an extra $2.8 million over your lifetime? What kind of charitable causes can that help? What kind of more comfort and peace of mind, and how many more trips and how many more gifts to the family members, to grandkids? You know, what do you want your retirement to look like, and use those savings to do so appropriately. I'm sure it would help you really, that 40 years that you've worked hard for all these years, let's maximize it. And this is the type of things that you can do to maximize it. So we have over 50 tax planning strategies out there that we utilize with our clients. This is just one fun one with the Roth conversion to show you how that impacts everything. If you are looking for this type of help, maybe your advisor's not doing it, maybe you're doing it on your own and you're just not sure how to make sure you're not missing anything. Maybe you just feel like I think I'm overpaying in taxes. I feel like I may be missing something. Go ahead and schedule a time in our description below, and you can actually meet with someone on our team here to go through an analysis with you to see where you are, see what you're looking for, and see if we can add value to your situation or not. So if that's something you're looking for, we'd surely be glad to help. And by the way, my name is Joe Schmitz. I'm the CEO and founder of Peak Retirement Planning. We're based in Columbus, Ohio, but we work with clients all across the country here. So hopefully you enjoyed today's video. And again, make sure you understand the importance of tax planning and saving money over your lifetime, because you've worked extremely hard for what you have. Have a great day. Hope you enjoyed the video today. As an avid viewer of this YouTube channel, we would like to offer you a free copy of our new book that just came out called I Hate Taxes. So if you would like a free copy of this, then go ahead in the description below. You'll be able to click on a link to get that free copy of this new book, I Hate Taxes.